What's going on, everyone? Welcome back to the Modern Mortgage Show, where I interview mortgage professionals who share their stories and valuable information about the industry. I'm your host, Rocco, and I'm happy to introduce our second guest of the day. His name is Jeff Winship, and he's the branch manager at Geneva Financial out of Shakopee, Minnesota. Jeff, welcome to the show.
Hey, thanks for having me, Rocco. I really appreciate the opportunity.
Absolutely. Thanks for coming on. So,
Yeah,
Jeff, can you please tell us a little bit about yourself and give us a brief introduction of who you are?
yeah, absolutely. I'm sure most people are wondering about why I'm dressed like I am. Probably should address that first and
We'll get
foremost.
into that. I got a question for that.
Oh, you got that saved. All right. Okay. Yeah, I've been helping people realize their dreams of home ownership for about 22 years now. Specialize in first-time home buyers as well as veterans, refinancing. So
So you've been in the industry for 22 years, you said?
that's correct. Yep.
And how'd you get your start in the industry?
Well, a friend of mine said, "Hey, you should come take a look at this." And I jumped in at a time where there were mortgages that were 125%, believe it or not.
Hmm.
So what
And
happened was the lenders would go 125% above the value of the property.
wow.
That was the last time we had Black Monday.
So did you do any type of work before you got into the industry?
I was actually a commodities merchandiser, and I sold whole truckloads of dairy feed, like cottonseed to dairy farmers and things like that. So it was pretty interesting, but much prefer mortgages, love running the numbers and helping people realize their dreams. I think too many of my colleagues just take it for granted, and I treat it truly as an honor to be part of somebody's dreams that they let you participate in that.
Absolutely. So Jeff, why don't we explain to the viewers what you're wearing and why?
All right. So the get up, I'm basically the mortgage loan, as in LOAN, ranger. And
Okay. And what does that mean?
well, it's just it's a way of standing out and basically branding myself. So people may not remember Jeff Winship, but they'll certainly remember some goofy guy in a hat and calling himself the Mortgage Loan Ranger.
And is it effective?
It is. It's starting to gain some momentum. I've been doing it for 2 years. In fact, I trademarked it last November because somebody came up to me and said, I was someplace last week and somebody stood up and said they were the Mortgage Loan Ranger, and they're saying, wait a minute, that's Jeff. So, in an effort to protect myself, I trademarked it.
Well, it's definitely interesting and definitely will stick. It sticks with you. So, moving along, we're at an interesting time right now in the world and in the market. So, why are the rates so high right now?
It's a great question, Rocco. We have seen we're in uncharted territory, as you indicated, and unprecedented rate fluctuations. And basically, 2 weeks ago, we were at all-time lows in the mortgage market, and we hit capacity. And capacity is the ability of the entire mortgage system. So I'm not talking about just Geneva Financial, but all mortgage lending hit a point where there was too much business. And if you can believe that, they had to slow it down. And so the next day, once we hit that point, they artificially raised the rates 1 to 2% to slow that business down. And
Hmm.
so the best way I can explain it is we have approximately $11 trillion in refinance volume that can be done this year. We were trying to do 5 trillion in 1 month.
Yeah, the rates were so low just a few weeks ago. Everyone's phone must have been blowing up for refinances.
Absolutely.
So you kind of touched on this. You love to help people. What would you say is the most satisfying or rewarding thing about your job?
Watching people's faces when they sign the final document and have the keys handed over to them, because that's when the realization takes place that, you know what, I'm finally a homeowner.
The biggest investment that they will make.
Yeah, it's the largest investment most people will make in their life. And as I said earlier, it's truly an honor. And I think if you look at my LinkedIn profile, well, I not think I know One of my statements is I've always put my clients' needs ahead of mine or the company I represent, and I believe in that firmly. I believe in taking care of the client as though it was my transaction. That's how I treat it. If I wouldn't do it for myself, I certainly wouldn't do it for my clients.
That's definitely a great statement. So shifting gears here, you've been in the industry for 22 years. Have you always been at Geneva Financial?
No, I've been with a multitude of lenders. It'll be 2 years this August that I've been with Geneva, but in terms of finding a home, this has been absolutely the best fit. They allow me to work autonomously. I'm pretty much my own boss, and I'm in an office of one, so I've been self-quarantined for quite some time now. I just realized that last week that I really have been on my own, and I don't have to worry about people coming in with social distancing.
So was that your number one driving force in making the switch over to Geneva Financial?
That and also just product availability. We have such a wide range of products that I could serve, really all areas. And unfortunately, due to what's going on in the market right now, we just had a suspension of one particular product, but that's because the market doesn't like risk right now. And because of that, that also is alluding to the higher interest rates. They're scared of defaults right now because of people being out of business. And so it's artificially raising the rates as a result of that. And it's creating uncertainty in the mortgage bond market right now.
So you're in Minnesota. Is that the only state you're licensed in?
No, it's a great question. I'm actually licensed in Wisconsin next door, Iowa below us, and then we'll drop down to the bottom of the nation. I'm in California, Texas, and Florida. But Geneva is licensed in 42 states. So where I'm not licensed, I do have other colleagues that can certainly help our viewers out as well.
Awesome. So what would you say when you first got your start in the industry 22 years ago? What would you say was your biggest struggle or obstacle that you faced early on in your journey?
Well, I mentioned we worked with just 125% mortgage. So all we were doing is second mortgages. And there was a client that came through that was in Mississippi. And this wasn't a big purchase. It was like 60,000. Well, it was a refinance. I take that back. It was like a $60,000 or $80,000 refinance. And our company didn't do first mortgages. And I put it in the system and I originated just like the second, but they had no experience. And so it just, unfortunately, it sat there and ultimately didn't get done. But that's probably my biggest frustration when I was with this company. It was called Samboy Financial, as a matter of fact. So,
Okay, awesome. So let's say you're talking to your younger self or just a young loan officer just starting out. What tips or piece of advice would you give to them? Someone who's hungry for business and just starting out.
I think the best thing that you can do is obviously be yourself, but get out and network. Networking is the best way to create a name for yourself, build trust, be in a community. If you involve yourself in, and I don't mean like your city, but I mean a particular community like the veterans, for example. And if you're serving alongside those folks, they get to know you, they get to trust you, and just by, I don't want to say osmosis, but by creating that trust, you build those relationships. You're the first one that they turn to for advice.
Definitely. Like I said in the first episode, your network is your net worth. And you put it best when you're really niche down and specific in a topic and you become an instant authority and you become an expert in that topic as long as you're nurturing and you're adding value to that community.
Absolutely. Well,
So in recent years, technology has really made an impact in the industry. Since you started, it's really made its way into the industry. How has this affected you in your business?
well, I think it just ultimately it makes us more efficient, improvement person. So I'm always looking for ways to get better. I think the danger, though, in the electronic age is that too many people want to just do everything online. And we encourage that if they don't have the time to go through an application. But Geneva's tagline is home loans for humans. And so, not to get lost in that, but I much prefer talking to people over the phone, answering their questions, running scenarios. Then if they like what they have to hear, then we can proceed and do an application at that point. But by doing the application over the phone or even in person, you gain so much more uh, insight than just by getting an electronic application that doesn't have that.
Exactly. Like you touched on it, technology is a good way of making things easier and more efficient, but there's always going to be that human touch and human element to it in order to really develop and build a relationship. So now let's move into kind of like the internet or social media side of things. Are there any, obviously you're branding yourself in a very great way.
Yeah, I'd say it's a unique way. I don't know about great.
It's a unique way that sticks, so it's effective. But are there any modern strategies that you're using now or that you're taking advantage of to maybe get more leads, scale your production, maintain better relationships, or even organize and systemize your business?
Well, I think obviously having a CRM, client retention management, which our company does provide for us, and so that's a terrific way to stay in front of people. I also do pay for a service that blogs on my behalf.
Hmm.
In fact, they sent out a how do I want to say it, a message or article today that talked about the low interest rates. And I sent back a response, please remove this because it's not accurate. But to the defense of people that are not entrenched in it, this thing is moving by the minute. It's not
Yeah.
moving by the day anymore. It's moving by the hour. You know, just 2 days ago, I had a client that we quoted on a purchase 3.375, and there were 2 points. So for those who don't understand points, that's 1 point represents 1% origination. So there's a cost to obtain that rate. The market had moved so much by the end of the day that same client was now being offered 4.5 for the same 2 points.
That's insane.
It moved that much in that short. So I don't fault them. Obviously, it's just it's a fluid market right now, like none we've ever seen.
So they write articles and blogs for you?
Correct. Mm-hmm.
That's really interesting.
Yeah.
After the show, if you don't mind sharing that service to me.
I'd be happy to.
So where do you see all of this going in the future, in the technology and the social media, in the mortgage industry specifically?
I think like what you and I are doing now, aside from the current environment, this is going to be a fairly standard way of doing things.
Yeah, I talked to somebody in an episode a few episodes ago, but before our interview, he had a closing, and it was a virtual closing.
Yeah,
So
that's
kind of like
becoming standard. And then, because and I don't want to get too deep on the virus thing, but it changes and makes us adapt. And so you're going to see where we're already seeing appraisers can't get into a home because people have self quarantined. So now they're having to do outside, drive-by type appraisals. Or I talked to one of my colleagues in another lender. They're doing Skype with the appraisers, and the borrowers are walking around and showing them the house. And so it's all about creativity and adapting in
exactly.
circumstances, and so you'll just see more of that, I think.
Exactly. So let's go to the buyer side now.
Okay.
What do you see as the biggest misconception or fear that your clients had before working with you?
Wow, that is a loaded question. I mean, the obvious one that everybody goes to is that you have to have 20% down payment. Nothing could be further from the truth. If you're a veteran, you can do zero financing. If you're in the rural areas, you can do 0%, not 0%, but zero down payment. Let me clarify that. So you have veteran loans that are 0% down payment, as well as rural loans. We have down payment assistance loans with credit scores down to as low as 620. Not sure how long that will maintain given the current market, but they will provide up to 3 to 3.5% of your down payment for you. So for those that find themselves short, maybe don't have the full 3.5%, but they've got a couple $1,000s, that works great because they can still get into a home. You can do loans with as little as 3% for first-time home buyers, or 3.5% if you're doing FHA. So
yeah.
it doesn't take a lot to get into it. I think the most important thing that I can communicate to our audience is you never want to be house rich and cash poor. There's too many people want to know what the maximum is they can qualify for. And one of the first questions I ask is, what's your budget? And the reason I ask that, Rocco, is because it's a qualifying question for me, because it also helps set the expectations. If somebody tells me they have $1,000 budget and they're in the Twin Cities where I'm located, Minneapolis, well, that tells me that we can look at about $140,000, $150,000 home a couple of weeks ago. Now with the rate going up, it's more like 140 because of that. So it helps to set their expectations, because 9 times out of 10, they've been looking on Zillow, they've been looking on the internet, and they're looking at a $275,000 house thinking that they can get a payment that's the same thing. And it's just not possible, because you have to take all of the components in place. You have the principal and interest, you have the homeowner's insurance, you have the property taxes, and anytime that you don't have 20% down or more, you always have mortgage insurance.
Mm-hmm.
And for a lot of people, mortgage insurance, to your first question, is a negative factor, but I don't think so, because it's how you approach it. If we're looking at, let's just use simple numbers, a $200,000 home, and we need 20% down, well, we need $40,000, correct? But if we do 10% down or even 5% down, the mortgage insurance portion that we're paying may only be $150 a month. So we're paying a little bit as we go, so that we don't have to come up with a lot up front. So I think it's just how it's presented. And it definitely, again, is a misnomer, because everybody thinks they got to have 20% down to avoid that mortgage insurance. Well, I would argue, Rocco, that we could take that other $20,000, we could invest it someplace else, let that money work for us, and at $150 a month, if we do the math, and I was sitting in front of you and I said, look, you write me a check today for $20,000, and for the next 30 years, I'll give you $150 a month. How many people are going to do that? It's going to take the good portion of that 30 years to get that money back. So it comes down to time value of money, and really just educating people so that they have a better understanding of that. And I really take a lot of time and pride in taking the time up front to explain, here's what the mortgage process looks like. You're going to need to pay for 1 year of homeowners insurance in advance. We have to also collect enough property taxes so that when those taxes are due, it's going to have enough money in what's called your escrow account. Just things that may seem simple to us, but for most people that are just getting into this, they don't know. I mean, and I think the mistake that my colleagues or competitors, whoever you want to say, they just assume people know that. And that's when you run into horror stories about closings. I found out I got a $5,000 right before the closing, and I had to scramble, and that's not right. Treat the loan like it was yours, and you're not going to have that.
Definitely educating them is very important, and just being upfront and honest with them is important as well. So just like you mentioned, there's no hidden fees or costs where they're scrambling near the end when it's almost closing time.
Yeah, and I do want to give a shout out to Jessica. I want to say Jaijan. She said hello early in the broadcast, so I wanted to make sure I acknowledged that. So
awesome. So you said that a down payment was a big fear or misconception. What about credit? Would you say that's a fear or misconception?
Yeah, credit is absolutely, and I'm glad you touched on that, because I have specialized in challenge credit for the better part of my career. And it's not rocket science. You can give me the score and I can usually tell you what's on your credit report. But there's so many people, and I don't know how in depth you want me to get, but I think this is an important thing to bring up. So many people are not taught how to use a credit card properly. And so what I'm saying is, it's great to get the credit card, and typically we get a $300 to $500 what I call garden variety basic card, but nobody tells you how to use it. So the first thing you know is you got to go out and use it because you got to create credit. So 9 times out of 10 out of that, let's just say it's a $500 card. 9 times out of 10, somebody uses it and puts $250 on their card. Well, if that's the only card that they have, they're now 50% of the only credit that they just worked so hard to get is in use, and you just dropped your score 30 to 40 points as a result of it. There are other people that are out there that basically say, pay your card down to 0. And I would argue that that's not the best thing you can do when you're trying to build credit. When you're trying to build credit, you want to leave that balance at 3 or 4% of the card limit. So if we have a $500 card, let's leave 15 to 20 bucks on it every month, and you will build that score much faster than any other way.
So how much of your credit line do you recommend using?
At any point in time when you're trying to qualify for buying a house or a car, no more than 20 to 30%.
Yeah, and that's something people don't know. So if they have a $1,000 credit line and they use all 1,000, or they have a $10,000 credit line and they use 1,000, now they're only using 10% of that line, but they're spending the same amount.
Correct. But that line, that larger credit line, is going to serve them better because they have more credit available to them than the guy that's got guy or gal who has the smaller credit limit.
Absolutely. Well, Jeff, I really want to thank you so much for coming on the show today. I had a great
opportunity.
I really appreciate your time.
Thank you.
Thank you to all the viewers for watching, and we will see you next episode.